Hello and thank you. My name is Zachary Stine and I'm here to discuss a financial analysis of two major industries, the retail consumer staples industry and the base and precious metals industry. For my analytical approach, I first look at the company's solvency. For short-term solvency, I examine the current ratio, quick ratio, and cash ratio to analyze their liquidity when it comes to covering current liabilities. I then examine long-term solvency, looking at their growth in long-term debt as well as their ability to cover said debt, looking at the times interest earned ratio and the cash ratio. I then turn to the core operations of the company, seeing how they create returns for shareholders by doing a 5-part decomposition of ROE, looking at the equity multiplier, the total asset turnover, and then the profit margin. I then also break up profit margin into the operating margin, tax burden, and interest burden. Finally, once I've chosen the strongest companies in each industry, I turn to the market measures, the price to earnings ratio, the market to book ratio, and economic value added. There I see how the market sees the companies and whether or not they're overvalued in creating returns for market capital providers. So let's get started with the base and precious metal industry. Here I look at 5 companies: Alcoa, Century Aluminum, Kaiser Aluminum, Newmont Gold Corp, and Encore Wire Corporation. Looking at the baseline averages for their solvencies, we see that all companies are solvent in the short term. But if you look at it, looking at the breakdown between the quick ratio and the current ratio, we see that a great deal of their current assets are held as inventory. So while they might be solvent, many of those current assets are rather illiquid. Turning to look at long-term solvency, we can see while debt has remained relatively stable, their ability to cover the debt has had some wild turns. It's also very important for this industry to not just look at the times interest earned ratio, but also the cash coverage, because of their large amount of long-term assets, depreciation expense can be large. So it's important to add that back in to see their ability to cover debt. Turning now to their ROE, we see, looking at this basic breakdown, again, their debt has been relatively consistent, varies by no more than 0.02 or so, but ROA has fluctuated wildly, and that's really what defines their returns. What's interesting here is you see how the equity multiplier both magnifies gains and losses. As soon as they turn up, you see how that really grows the returns for ROE coming from their return on assets. Turning to the ROA breakdown, we see that their total asset turnover has remained relatively stable, so profit margin is really driving the return, and operating margin represents that. A lot of these fluctuations are related to the pricing of aluminum. In latter half of 2015 and 2016, aluminum prices hit a bit of a low and then began to rise after that, and we can see that represented in the curves on their operating margin. Now, looking at Alcoa, Alcoa is one of the leading producers of bauxite and aluminum in the world. It operates in 10 separate countries. Recently, the company split their fabrication unit from their smelting and mining unit. Alcoa Corporation we're discussing here is the smelting and mining portion. Now, we see with their short-term solvency, it did take a dip in the early 2015-14 period, but it's been recovering since then. In 2016 was when they had that split between the two companies, and one goal was to really strengthen the balance sheet, increase cash and assets, and we can see that in the curve. So they are the weakest when it comes to short-term solvency in the industry, but they have recovered slightly, and as we can see also their current assets are about 60% inventory, so what they do have is rather illiquid. Now, turning to their long-term solvency, we see they have the highest debt, but they also have the highest ability to cover that debt. So it's not necessarily a big issue for them because they do have those earnings to cover the interest payments. Now, we also see that in 2016, we see that effect of that split as well. We see how the surge in the aluminum prices and the split between the two companies really increased their earnings and increased efficiency, and that paired with the increase in aluminum prices really helped them cover their interest payments quite easily. Looking at their ROE breakdown, we see that they are below average for the industry. They also have the highest equity multiplier, and again we see here how that equity multiplier is really magnifying those shifts in ROE. Little changes in ROA are magnified by the equity multiplier to create these changes in ROE. Now looking at the breakdown in ROA, it has one of the worst in the industry. Their return on assets is very low, and a lot of that is driven by the profit margin. Again, the fluctuations in aluminum prices have affected them quite a bit. We have seen, as you can see with that steep increase in the operating margin there, the blue line, we see that with the recovery of aluminum prices in 16 and 17, so they benefit a great deal from that. Now, the benefit, though, hasn't necessarily, in operating margin, hasn't necessarily manifested in profit margin. One reason for that is their interest burden and tax burdens have varied wildly. Their tax burden has decreased quite a bit. They're paying a lot more in taxes over the past 3 years. Same with their interest burden. So we can see that while operating margin has increased, the decrease in tax burden and interest burden has kept that from manifesting in larger returns for equity. Turning to Century Aluminum, Century Aluminum produces high-grade aluminum. It's used by a lot of military vehicles for the U.S. Armed Forces. Now, one concern for Century Aluminum, if you look at their supply chain, is that they only have really one major buyer. That's the company Glencore. Currently, they account for about 60% of the revenue. Over the past 5 years, it has been as high as 90% of their revenue has gone to Glencore, which does create some concerns when it comes to long-term growth. There's some issues there if anything happens to that major buyer. Now, looking at their short term, we see they are the most consistent with the average for the industry. They did have a steep decline in cash in 2017, which pulled a lot of the other ratios down. We can see that curve there. A lot of that was due to negative cash flows from operations as well as major investments in capital expenditures. They also have the highest percent of current assets held in inventory. So again, that means that the current assets they do have is less liquid, so covering liabilities can be a little bit more difficult. Turning to their long-term solvency, we see their debt has consistently risen since 2014. Despite that, though, it has remained relatively consistent with the industry average. We see with these major spikes that their ability to cover that debt has changed quite a bit. Again, a lot of this flows from the changes in aluminum pricing affecting earnings. So that top of the line price really affects their ability to cover debt. Now, looking at the return on equity, it's generally below average. They have only had positive return on equity for 2 years, which is not very good for shareholders. We also see that their equity multiplier has increased slightly, but ROA is really what's driving their ROE here. So now turning to ROA, we see again that total asset turnover, like many in the industry, is pretty consistent. That's not really the driver of shifts in ROA. That all comes from profit margin, and as we see here, profit margin and their operating margin follow the same pattern. Operating margin is driving that profit margin, and again, like Alcoa, we see that that drop in 16 for aluminum prices really hurt their margins and in turn hurt their returns. Looking now at Kaiser Aluminum, Kaiser works more in the fabrication of aluminum products. They sell to aerospace, defense, and automotive companies. Now, like Century Aluminum, they do have a consolidation of revenue from a few buyers. It's not quite as bad as Century Aluminum, but 4 customers do account for about 50% of their revenues. Now, looking at their short-term solvency, we see that the ratios are above average except cash. They hold very little cash compared to the rest of the industry. So while their ratios are above average when their current assets to current liabilities, those current assets are illiquid. A lot of this cash decline, though, has been related to debt repayments and stock repurchases. Looking at long-term solvency, we see they have the second lowest debt in the industry. The debt has increased, but so has their ability to pay debt. Now, we see this giant fall in 2015 when it comes to their ability to pay. Their earnings took a major hit that year. Interesting to note that this wasn't related to to aluminum pricing. Rather, this was a non-cash outflow. It was an other operating expense that related to a changing in accounting rules for some of their unions and pensions. So while it does look drastic here and their earnings did fall, it was a non-cash outflow for an expense. Now, looking at ROE again, ROE and ROA, we can see that dip due to that increase in expenses. But besides that, ROE has been consistently above average. and more importantly, they have a below average equity multiplier, which means that what's driving their return on equity is really their ability to utilize their assets and create returns. So looking at ROA, we see their asset turnover has averaged about 1, which means that all of that return on equity and return on assets is flowing from their profit margin. And we can see the profit margin and ROA move almost in lockstep there. So that's what's really driving them. Now in 2015, again, we had that dip, but non-cash outflow, so not something to be concerned about when it comes to long-term. Looking at Newmont Gold Corp, they recently became the largest gold company in the world. Newmont bought Gold Corp earlier this year. They're the third largest producer of gold, and they are the single largest holder of gold assets in the world. Now, again, like others in the industry, they rely on two major buyers, two banks, provide 50% of their revenue when it comes to gold sales. Their short-term solvency, we can see, has been a little bit rocky, but it is above average solvency, so they are still in a good territory there. They also have the highest cash to current ratio. A lot of that buildup in cash was related to the Gold Corp acquisition. Like I said, that was earlier this year, and interestingly, the outflow of cash from that has not yet hit the books, so we'll likely see a lot of these ratios fall once the deal finally hits the books. Looking at long-term solvency, we can see they had a dip in 2015 when it comes to their ability to pay, but we also see a decline in debt. Again, a lot of that is related to preparing for the acquisition for Gold Corp. They'll be taking on about $2 billion in debt from that acquisition, and that, again, will hit the books soon. So we'll see these fluctuate. But generally, they do have a strong ability to cover that debt. So, turning to their ROE, we see it as above average, but it has been dragged down by low ROA, as well as we can see this decline in the equity multiplier has also caused that number to fall. But ROA is really the main culprit here. Now, turning to that ROA breakdown, we see that the total asset turnover is well below average. One could think that because they're holding so much cash for that acquisition, it's driving that number down. Cash does not produce many returns, so hopefully we'll see that increase as a lot of this cash moves off their books, but we'll see. Besides that, they've had negative profit margin twice, which has really hurt their numbers. That's due in 2016, they had issues with their operating margins, higher expenses, and then 2017 they had some issues with deferred taxes as well as loss on discontinued operations. Overall, though, we see that ROA is really driving things here. Now finally, the last in this industry, we have Encore Wire. Encore Wire I actually left out of a lot of the averages for the industry when it came to solvency because they are so solvent. Their numbers are extreme outliers. They actually have no debt. The few liabilities they do have are mainly trade receivables, and we kind of see that represented in these solvency numbers. Their current ratio is well above 6, moving closer to the 10 range, and we see that they are holding a large amount of cash. They're one of the few in the industry that have a cash ratio above 1, very uncommon, and the highest percent of their current assets are actually held in receivables. Looking at their long-term solvency, we can see that their ability to cover debt is without question, being that their debt is 0. Even their line of credit has been paid down to 0, so we're talking about EBIT to interest margin or ratios that are close to 300, so no problem when it comes to covering debt. Now looking at their ROE breakdown, because they have so little debt, ROA is pushing everything here. So they have had, their lack of debt means that ROA is driving everything. The slight increase in debt could cause ROE to explode if they just took on a little bit. That equity multiplier would increase and they could do a lot more, create a lot more returns. Now looking at that ROA, they have the highest total asset turnover in the industry. One part of that is they're really focused on highly automated production facilities, so they're extremely efficient there, and they're really focused on using that efficiency to fill orders as quickly as possible, really driving up that asset turnover. They also have the highest profit margin, which has been driven by their rising operating margin as they really work on efficiencies and cutting costs and things along those lines. Now, when it comes to best in industry, I was caught between Kaiser and Encore Wire. As we can see, ignoring this dip here due to the non-cash outflow from Kaiser. They've been relatively consistent. Encore Wire has been a little higher when it comes to return on equity at a few points. But really what concerns me is that lack of debt. Now that lack of debt for Encore Wire does show some potential, but as we can see looking at the EVA spread, their refusal to take on debt means that they've not actually had positive economic value added. That's because they're not taking on the lower cost of capital that debt can provide, and that is concerning. Moreover, we see that Kaiser Aluminum has a higher price to book. The market sees them doing a lot more with their assets. They have a lower cost of capital, so they're producing these positive economic value added returns. Not huge, but still positive, so they are producing new wealth and value for their shareholders. And because of that, Kaiser is the best pick in this industry. Wire does have a lot of potential, but they really need to rethink their capital structure. So moving on to our second industry, retail and consumer staples. A lot of these brands we all know: Costco, Dollar General, Kroger's, Target, and Walmart. Looking at their averages, we see that the industry faces some solvency concerns. As we can see, this top blue line, their current ratio has been declining over time, and it often is below 1, meaning that their current liabilities are greater than their current assets. Also, we see that they have extremely high percentage of their current assets held in inventory. We can see that between the gap between their quick ratio and their current ratio. So again, that makes it a little illiquid when it comes to their current assets, and which is even more of a concern since that current ratio is so low. Now looking at their long-term solvency, we see debt has trended upwards slightly since 2015, but they have all maintained a relatively comfortable ability to cover those interest payments. So the debt isn't necessarily a concern since their earnings are so much greater than their interest expense. Now looking at the ROE breakdown, these lines are far less volatile than the precious metal industry and base metal industry. We see that ROA really drives ROE here. The orange line here is being higher than equity multipliers, driving this extra return. Now looking at that ROA breakdown, asset turnover is relatively stable within the industry. That is a goal of many of them, is to increase that, but it's relatively stable. And PM, their profit margin, is of course driving ROA in that case, and operating margin is key to that profit margin. We see that it has declined slightly. A lot of this is due to trade tensions affecting prices and how those prices pass on to consumers, and also the drive for e-commerce. Many of these companies are trying to compete with Amazon, and while e-commerce is an opportunity, it does have smaller margins, so that has affected their return on assets and return on equity. Looking at Costco, Costco is a wholesale membership warehouse store. It is actually expanding numbers of stores when companies like Walmart and Kroger's are closing some down and not expanding, so that's quite interesting. They haven't expanded much to the northeast. Only about 12% of their stores are there, and that's one of their goals. They'll be opening 20 stores in the next year. They also have multiple revenue streams when it comes to their memberships fees, as well as providing gas at their stores and providing long-term or long-distance phone deals and other likes to their top-level members. Now, looking at their short-term solvency, we see the solvency is slightly above average, but it's still, their current ratio is still below 1 with that decline over the past couple of years, and the highest percent of their current assets are held as cash for the industry, which is interesting. About 36% of their current assets are held as cash, so now they might have dipped below 1, but their assets are more liquid than most in the industry. Looking at debt, we see that debt is trending up, but it is still below average. And more importantly, their ability to pay for this debt is the best in the industry. They have a EBITDA to interest expense above 35, so earnings are 35 times higher than their interest expense when you add back in depreciation. So they're very comfortable when it comes to paying for debt. Looking at their ROE, we see that it's steadily increasing ROA and equity multiplier, and that has together magnified their ROE over the past couple of years. We can see with this trend line upward. Now looking at but ROA is still quite important. And looking at their ROA breakdown, we see that profit margin is below average, and this is key to their business model though. Their goal is to provide low cost goods to their consumers, so low profit margin is what one would expect. but their total asset turnover is extremely high, much higher than average, and that's what Costco prides themselves on, their ability to know what sells and keeping a smaller number of items that they know will sell and then being able to turn that over and increase those sales per store. Now, turning now to Dollar General. Dollar General is a chain of discount retail stores. It is more rural when it comes to its locations, which gives it a competitive advantage. It's looking to be a quick stop for many people on their way home that don't want to go into the large stores. It also provides access to people that might live in rural areas further away from a Walmart Supercenter or a Costco or the like. Now, one thing is that due to their low prices and their model, they are more exposed to the trade tensions in China, with China and globally, so that is a concern they have moving forward. But looking at their short-term solvency, we see they are the most solvent, but they're also very illiquid. Almost all of their assets, current assets, are held in the form of inventory. Their receivables are zero, so it's really cash or inventory for them when it comes to current assets. In 2016, we see the cash decline a little bit, but that was due to financing and investing activities, not necessarily a slowdown in operating cash flows. Turning to their long-term solvency, we see their debt is lower than average, but they also have the second highest ability to pay that debt. So right behind Costco, they're really able to cover that debt easily with their earnings. So increasing debt is not necessarily a concern. Turning now to their ROE, we see their ROE is consistently above average. Their equity multiplier stayed relatively stable and below average over the past 5 years, which means it's really that core operations, that ROA, which is driving things. Their above average ROE is driven, like I said, by that above average ROA. So now looking at the ROA breakdown, unlike Costco, profit margin is key to their ROA. It is the highest in the industry. That's really where they try and make their money in being able to get that margin up. Now, higher expenses lower their operating costs, and we can see that these dips here have been due to those higher costs in the recent years with the trade tensions, so that has affected them. But we see that their profit margin was maintained a little bit with that dip in the operating margin was protected by the dip in their taxes. So their tax burden increased with the tax cut in 2017, which helped maintain their profit margin a little bit. Now turning to Kroger's. Kroger is the largest traditional grocer in the country. It operates a variety of stores under different banners, and right now they're actually going through a $9 billion capital investment strategy. Looking at short-term solvency, they are the least solvent in the industry. Their current ratio is below 0.8 quite often. It's now around 0.75, so about a quarter of their liabilities they can't cover with current assets. And about 80% of those current assets are in inventory, the most illiquid, so their solvency short-term is a concern. Now, long-term, we see they have the highest debt ratio of any at 5, so that is much higher than normal. They can cover the debt. They do have a cash coverage ratio as well as a times interest earn ratio that can cover the debt, but it's still lowest in the industry, so while they can take on some more debt, they are getting close to a point that might be concerning. So now looking at their ROE is well above average, but again, let's remember that they have very high debt, so that equity multiplier is playing a very important role in magnifying their gains from ROA. We see their ROA and their equity multiplier have remained about the same over the past 5 years, so it's really that debt is really magnifying that ROA to get these high return on equities, because their ROA is actually below average consistently. And looking at that, we see asset turnover is average, and it's really what's driving ROA for them, which is a little interesting in the industry. We also see that their below average operating margin has depressed their profit margin from time to time, affecting that return on assets. And controlling costs is really key to them. That's one point for their $9 billion investment, really creating more efficient stores and driving those same store sales so that they can increase that ROA and that profit margin to help with their returns. Now, turning to Target. Target is the second largest discount chain in the United States. It offers more upscale, trend-driven selection than some of its competitors, and it recently made 2 major acquisitions trying to help with its e-commerce capabilities. So looking at short-term solvency, it has been on the decline over the past couple of years. It is a definite negative trend. Also, like Dollar General, they have no receivables, so their current assets are held either as cash or as inventory. And on average, about 81% of their current assets are in inventory. So again, a little bit somewhat concerning when it comes to the ability to cover short-term issues. Looking at long-term solvency, their debt has been trending upward and it is slightly above average. Now their ability to cover that debt has trended upward as well since 2017, but that was not necessarily due to an increase in earnings, rather it was due to a decrease in interest expense. So they can still cover their debt, but they're not quite as comfortable as some in the industry. Looking at their ROE, we see that in 2015, very weak year for them. They had a loss that was related to the discontinuation of Target Canada that required them to bank a $4 billion loss on discontinued operations. Since then, they have restabilized their return on equity. Steadily increasing debt has helped push up ROE. But we see ROA fluctuations have been minimal. Their ROA has been consistent. Only hasn't fluctuated more than about 7% over the past 4 years. It's been relatively stable. Now looking at that ROA, it is above average, which is good for them. Their total asset turnover is below average, but it's stable. And profit margin is really what's driving things. Interesting though is that their tax burden and interest burden have maintained, so we see PM is really, their tax burden and interest burden have helped maintain their profit margin as their operating margin has declined, which is interesting. With the tax break in 2017, that really bolstered them and helped with their decline in operating margin. We see they've been able to maintain ROA a little bit better. Now finally, we turn to Walmart. Walmart needs very little introduction. It is the world's largest retailer. It has recently been doing major investments in technology and e-commerce, really trying to get ahead of the curve when it comes to the evolving retail space and with the threat of Amazon trying to protect themselves. So looking at their short-term solvency, we see that it is on the decline. All ratios are consistently below average. So they're really in the short term, their current assets to current liabilities can be a concern. Looking long term, we see the debt ratio is below average, but it's up by about 24% since 2015. And moreover, their ability to pay has declined as earnings have declined and interest has grown. Now, they're still in a comfortable position, but the trend, is if this investment doesn't eventually bring returns, it can be a concern. But again, a lot of this increase in debt is related to their investment to be more competitive in the future. Looking at their ROE, we see their ROE has declined by 40% since 2015, rather steep. ROE has been pushed down by declining ROA. Currently their ROA is half the industry average. Now looking at the ROA, their asset turnover has remained stable, but their profit margin decline has really been what has harmed their ROA and harmed their ROE. But this decline in profit margin is somewhat strategic as Walmart begins to be more competitive in e-commerce, trying to compete with Amazon and really be prepared for the changing retail world. They've put so much into e-commerce, and e-commerce does tend to have lower margins. So they've sacrificed a little bit to make sure that e-commerce can be a loss leader as they move forward. We also see that their interest burden and tax burden are down, which also has harmed their ROA. Now, looking at the industry as a whole, it's really a competition between Dollar General and Costco. I had a hard decision looking at these two. We can see that their ROEs have been pretty consistent comparisons, but really what came down to it was looking at the ROA. Dollar General's ROA is much higher than Costco's. Costco's is a little bit closer to average, which means that Dollar General is doing the best when it comes to really utilizing its assets. Both companies have very strong strategies moving forward. Both are opening new stores. Dollar General is opening 1,000 in the next year, while Costco is opening 20 or so. Both have strong strategies when it comes to Costco moving in a little bit more into e-commerce and growing their membership base, and Dollar General is beginning to take a little bit more control of their their supply chain, which helps protect that profit margin. They know that they can suffer with macro trends like trade tensions and things like that, so they're trying to have a little bit more control of that, as well as move in items that will offer a little bit more margin, really strengthening that core of their ROA. Really, when it came down to the decision, though, it was about the market measures. As you can see, the price to earnings ratio for Costco is much higher than Dollar General. It's around 30. That makes me think that they're overvalued. I do think that their investments are going to create growth, but right now I think that the price is a bit too high compared to Dollar General. And we see that similarly reflected in the price to book, same relationship. So both, I think, have a strong outlook for the coming years, but I think Dollar General right now is priced better. I think it's going to be a better buy and investment for long term. And really, Dollar General, comparing the two industries, Dollar General, again, is the best choice. The precious metals and base metals industry has a lot of problems that come with it when it comes to commodity pricing globally. It faces threats as countries like China begin to increase their ability to produce aluminum and metals domestically rather than buying from international competition. So really, when it comes to the threats there, Dollar General is the best bet over Kaiser Aluminum as well as Costco. So thank you very much for your time today. I hope you've learned some about the base and precious metal industry as well as the retail consumer staples space, and thank you very much.